Welcome to All Things Financial with Jack Driscoll. Each week, Jack takes on all things you thought were hard to understand about your finances and makes it fun, easy, but most of all interesting. From insurance to the best way to save your money and squeeze the most out of the dollars you put aside for your rainy day. And now, you have a friend in the money business. Here's your host, Jack Driscoll.
Welcome back again, everyone, to another edition of All Things Financial. I wanted to talk to you because we're getting near around the holidays time. We get to gifting and issues like that at near year end. So sometimes we do tax planning before the end of the year. Sometimes we look at gifting. Sometimes we look at many different areas this time of year, a little more heavily than some of the other times in the middle of the year. So I wanted to share some of those strategies today and just get on top of your minds some things that you could do before year end that you should be maybe thinking about or hadn't thought about. So we'll talk a little bit about college education, gifting from grandparents maybe to help out for college, how to do that. I'll touch on a couple of those areas. Some of the gifting limitations that I get asked those questions all the time. And also not to forget charitable gifting. So over the next couple weeks, I'll probably touch on a number of these areas in more detail for you. But today I wanted to give you a little summary of some of the topics we probably want to think about now that we're close to the last month of the year. So let me first start with an issue of average gifting, maximum limits, things like that. Now, I've talked about this, and you've probably seen many articles on this, but I wanted to touch on the one question that we keep getting asked: how much are we allowed to gift every year? Is there a maximum on the amount of we're allowed to give? Is what we give to another person taxable? See what I mean? So let's start with the maximum annual gifting amount one person, any one person, can gift to another person. Now, again, between spouses, it's easy, but outside of that, we're talking about gifting to grandchildren or relatives or something like that. Anyone that wants to gift to another person, there's a maximum annual gift allowance of $14,000. That's an allowable amount any one person can gift to another person in a taxable year without having to file a gift tax return. Here's what that means. I've said in other shows there's no maximum allowable amount you're allowed to gift. It's just a maximum allowable annual gift before you have to file a gift tax return. So I want to refresh in your memory that no matter how much one person gifts to another person, it's not generally taxable to the other person. Because filing a gift tax return, let's say you exceed the $14,000 limit, so what? You have to file a gift tax return. The gift tax return is only a record-keeping or score-keeping return. It's really not a tax return unless your gifts exceed your estate and gift tax maximum limits for the lifetime, which are they're over $5 million you're allowed to gift over a lifetime, or in combination have someone inherit after you're gone, before there's an estate and gift tax at all. So I don't want you to get caught up in this annual gifting. That's the most amount that's allowed. So when we gift, I want you to consult a tax advisor and confirm what I'm saying so you could see and any of our clients listening, give us a call. Anyone who's listening to the show or watching it, give us a call. I'll go through the actual guidelines, even so far as comparing them with your own tax return, to help you see and identify the consequences if you gift in excess of $14,000. Now, why would you want to do that in one calendar year? Well, maybe you want to help your grandchildren pay off their college loan debt that they've accumulated and they're now out of school and seemingly will never be able to pay that. And you might think to yourselves, why don't we eliminate that burden and responsibility rather than waiting till we die and they inherit it and maybe are then able to pay off their college loans? Why don't we help them now? Well, folks, most of us can and still have it not be taxable. So many of you retirees and seniors who are listening to the show and watching the show might say, I want to do something nice for my grandkids or my kids even, and alleviate some of the debt and responsibility. Why should they have to wait until we pass away? Well, you're able to do that typically with no income or gift tax consequences with proper planning. So if you look in advance, you may see we could give them some of our assets that we now know, because of dealing with our financial advisors, we'll never need those assets. Give now instead of giving later might help both. You get to receive the benefit of seeing the consequences of relieving all that college debt, and they get to benefit earlier without having to struggle for so long. So what would you say if you were limited to only $14,000 a year and they had $120,000 of college debt accumulated that they're paying 7 or 8% interest on and seemingly will never be able to get that paid off? You could swoop in sometimes as grandparents, save the day, make their lives a lot easier now while they're trying to raise their newborn kids, and they're under this insurmountable debt. So yes, you can help them earlier rather than later, and didn't know that in many cases. Surround yourself with a team of good tax professionals, good legal professionals, good financial professionals that can help you in your own individual situation. But feel free to give me a call. I'll give you some general information, even right over the phone, that can help guide you at least. So that's one area near the end of the year you can think about. Another area is, please don't forget, anyone who's in an IRA and over age 70 and a half, we still have the ability to make a charitable gift directly from the IRA and not have it be deemed as taxable income. It serves as your required minimum distribution and goes straight to the charity. So we've talked about the pros and cons, but near the end of this year, don't forget that strategy. It may be beneficial for some of you and may not be as beneficial for others. So again, every case is unique and individual. So get your own consultation there, but don't forget that strategy. Now here's another one. Let's say we're looking to give gifts at Christmas time because it is the holiday season coming up. And again, grandparents, I'm talking to you in this case, we might look and say, we want to put a gift or make a gift on behalf of grandchildren. And rather than buying gifts, we may want to do something different. We may want to fund their future college education. So now we're talking 529 plans. Well, here are two similar strategies toward the same goal, but vastly different. One, instead of putting $1,000 and gifting that to the child or grandchild, some people will say, every year instead of doing $1,000, I might put $1,000 into a life insurance policy on me, the grandparent, and insure my life where I'm leveraging up that benefit. Now, here's what we're looking at. Some people will say, instead of gifting $1,000 a year to a charity, or $1,000 a year to a grandchild, or $10,000 a year, whatever you're giving, they'll leverage up that benefit for a future life insurance death benefit. So if I do $10,000 a year or $1,000 a year, right now the benefit to the recipient, whether it's a charity or a grandchild in this case, might be the $1,000 every year that accumulates. But if I do $1,000 into a life insurance plan on myself, it may buy $100,000, who knows, depending on health and age, at the time of my death, far out leveraging the benefit that the actual principal gift would have done. because of the leveraging of life insurance. So I want you to think about that because you're able to convert it into a potentially tax-free death benefit to them at now or later years. If you do the 529 plan or if you do a direct gifting to a charity, it still is fine. You could do either, but I'm just expanding your minds as you're listening to the show and watching the show on different areas that you can maximize gifting. So let's talk about the charities. If you gift to a charity, I want you to think about, instead of gifting cash, would it be of benefit to gift stocks, bonds, or other appreciable assets that you would otherwise owe tax on if you cash them in? But if you gift those actual securities, stocks and bonds or whatever, the total value goes to the charity. When the charity, if it's a let's say 501c3, for example, totally tax-free for income purposes, that charity could liquidate the stocks and pay no tax on that liquidated value. Whereas if you liquidated the stocks, then donated to the charity the cash, you would have first had to pay potential income tax on those stocks, for example, or any appreciable capital asset. So you could avoid the tax by gifting appreciated securities. And we've talked about that in the past. So don't forget that, folks. It's not all about only gifting cash. You can gift other assets to charities and maybe maximize your benefit and their benefit. Now, when you gift to a charity, you get a gift tax deduction. And it depends on what type of asset, whether you gifted cash, whether you gifted stocks and bonds, or whether you created a charitable remainder annuity trust or a charitable remainder unit trust or a charitable lead trust. You can establish trusts, transfer assets into trusts, and then have split benefits where you, the recipient, or you, the donor, actually, are part recipient of income from that trust for as long as you live, and when you die, the charity inherits the remainder of the trust principal value. That's a future interest trust. So there are lots of ways to benefit charities without taking away all of the use of the assets to you while you or your spouse, let's say, are still living. These are the things I want you to start thinking about near year end here. Now let's talk about college. We get into the area of, we have a struggle, parents, grandparents, and some people don't have children and are looking to benefit their nieces and nephews and other parties. So let's talk about that. If you want to, as a parent or grandparent, you can contribute to a child's 529 plan or a grandchild's 529 plan. So let's talk about that for a minute. There are limitations, but there are also benefits. So let's talk about the child. Some of the complaints we've seen on 529 plans are, yes, they're tax deferred accumulation, and yes, they're tax free if the 529 plan is liquidated for the purposes of paying college tuition at the year college tuition applied. Then the benefit is that you could pull out of a 529 plan, never pay tax on the principal, and never pay tax on all the earnings or accumulations over all those years because it was used for its intended purpose, which is funding college education. So everything's fine there. The problem, or one problem, is when monies are pulled from a 529 plan, when they are pulled out, yes, they're tax-free, but they are considered a benefit or income on behalf of the student, and it can affect the FAFSA and expected family contribution. The student may receive less in funding, less in scholarships and loans that are income or asset-based. Ouch. So here you do the 529 plan, and then at the time of college, those funds are being withdrawn. The college financial aid package for the student is being reduced because then the 529 funds are now coming out. And guess what else? When you make a contribution into a 529, we are seeing problems with the FAFSA, and there are new rules on this, and I want to share them today a little bit, but there are new rules on the FAFSA. When a parent, or especially grandparents, contribute to a FAFSA, or contribute to a 529 plan, the problem is the FAFSA. FAFSA. I've talked about this in many shows, and I'll talk about it in many in the future. But every student and parent usually files a FAFSA report to see what financial aid they'll qualify for. And everything seemingly counts against eligibility for a FAFSA for your state and federal and even local and college-affiliated financial aid packages. So what we're seeing is, what do we need for a FAFSA? Well, we need last year's income tax return. And what we're sometimes seeing is grandparents' contributions to the 529s can sometimes be seen as income. So sometimes grandparents are saying, wait a minute, through sophisticated strategies, we don't want to contribute to the FAFSA or directly to your college funding because it's going to reduce the college students' financial aid package because it's going to show up on the tax form. So the income tax form, when the child's a freshman, that doesn't sometimes work. When the child's a sophomore, it's still too soon for grandparents to contribute a lot of times. Not until the senior year. Well, there's a new rule in the FAFSA that can help a little bit in that now the FAFSA is saying, first off, we could do a FAFSA 3 months in advance of when we were able to do it. So I want to bring that up right now. Those of you, we are in November. Those of you who have not already done a preliminary FAFSA, go ahead and do it now, because they've given us a 3-month pre-FAFSA, I'll refer to it as, opportunity to file the FAFSA before we have the income tax returns finished, because obviously we don't have this year's income taxes done because it's still in November. But they're allowing us now, the FAFSA, to file a preliminary FAFSA and use 2 years ago, because if we're looking at the next year's funding, 2 years ago, income tax returns. Well, now that opens the window for grandparents, because grandparents can now put funds aside on behalf of a student, a grandchild, nieces, nephews, and it doesn't show up yet on this year's FAFSA because they're using 2 years ago tax returns, and the grandparents didn't do it. Make those contributions 2 years ago. So what happens? In the freshman year, the FAFSA is looking at 2 years ago. So the grandparents' contributions this year, for instance, aren't showing up. In the sophomore year, we're still looking at 2 years ago returns. The grandparents' contributions still don't show up because they first made contributions, let's say, for the freshman year. The problem is the junior year, now looking back 2 years, the grandparents' contributions do show up and may knock that student's financial aid package down for the junior year and again, consequently, for the senior year. Well, now what we're starting to see is specific tax strategies. So I implore all of you, now that we're near year end, whatever situation your students are in, or potential students, maybe they're juniors in high school, now's the time to start doing sophisticated planning, grandparents. Work with your kids. Work with the parents of these students you're trying to help. Should you gift directly? Should you do this? Should you do that? In addition to the $14,000 annual gifting that you're allowed to do anyway, will that hurt the financial aid packages if you gift money to the grandchildren? And think about this. Should you at some point in time gift money directly to pay the tuition to the colleges, because that doesn't count against the $14,000 annual gifting? Or should you gift to, if anyone has any medical expenses? You know, I've talked about this before. That's a gift that you can also do and does not count toward that $14,000 annual gifting. So again, I know all this is sounding complicated, because it is, but look at the strategies, how they weave together. Grandparents. You can gift capital assets to charities. You can gift cash assets to charities. You can gift money into life insurance. You can gift money actually into annuities. You can gift money directly to the grandchildren. You can gift money directly to the parents. You can gift money to the 529 plans. You can actually multiply the annual gift of maximum of $14,000 a year without having to file a gift tax return, and do 5 years, all accumulated in 1 year, and still not have to file a gift tax return if you're gifting that money straight into a 529 plan. Do some tax strategies and tax planning to make sure, though, that we're not knocking down the eligibility and, in fact, maximizing the eligibility of the student to obtaining the maximum amount of college financial aid, loans, scholarships, and otherwise available through federal, through state, and through the colleges themselves. And don't forget, folks, the scholarships that are available through many of the organizations out there that are free money for the taking and being lost for people not applying. So don't forget, I've done this in prior shows, many scholarships go unfunded, untapped, and the money stays in the program, that if even one eligible student had applied, they would have won the college, because no eligible students even applied for lack of not even knowing they existed. So that's contact the Lions Clubs and the social clubs and all the organizations around and asking them, do you have any scholarships? Do you have any loans that don't have to be paid back? And do you have any grants that you do every year? And what are the eligibility requirements? So get working on that, folks. Do the internet searches on those. Find out all the resources that are available. And simply for spending time doing applications, there's free money to be had that a lot of people are missing. All right, folks, we're out of time. I've covered a lot on the show. I'm trying to get you to think about a lot of different areas now that we're near year end, to help you with your own individual planning. Again, feel free to contact our office. I'll be glad to help you. We'll meet together if you'd like. No obligation appointment, and help you navigate through some of these strategies that none of your other advisors are bringing up or talking to you about. Therefore, you're missing out on. Thanks again, folks, for tuning in to another edition of All Things Financial. We'll be back again next week.
Securities and investment advisory services offered through SagePoint Financial Inc., member FINRA SIPC, and registered investment advisor. Insurance services offered through Driscoll Insurance and Financial Services Inc., which is not affiliated with SagePoint Financial Inc.